Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Want to talk about some data points that came out today, some Fed members that came out today, said a couple of things, and what's happening today in the stock market and the bond market. So let's start off. We got the PPI numbers, which is inflation numbers. The producer price index came in lower than expected. Not surprising there because we saw CPI come in lower. We expected inflation numbers to come down lower, and so did the PPI, especially as demand starts to go down lower and starts to crunch. Yes, that's why PPI has come down. So it was as expected. But yes, the number did come in lower than expected. Retail sales, which basically is a very important number. It's also important in determining how consumers are spending, how GDP may look like down the road as well. Are there consumers spending out there? What's happening? So you've also seen retail sales in today's number basically drop as well, come in lower than expected in the negative, which is suggesting that, hey, there's not much retailers out there going out and buying certain goods, right? Things are very expensive. Just look at the eggs. They've got even more expensive, right? Essential things are becoming more and more expensive. And yes, you're not going to go out and buy some of those luxury goods or those discretionary items. You're not going to go out and buy those Teslas if you love Tesla so much. And that's why Elon Musk went out and cut his price on the car. Right? So you're seeing that demand crunch. You're seeing that play out. And this is just the start of the year. This is just January. We're just beginning here. Right? And now with that number coming in weak, you did see the stock market basically sell off a little bit, pick back right back up on P1 because what's the theme? Bad news is good news for the stock market. If you got bad data, like retail sales, and you got inflation coming in lower, then guess what? The stock market's thinking that, hey, the Fed's not going to tighten as hard because look, the data is bad, right? Maybe they're right, maybe they're wrong. We'll see. We'll see how long that lasts. But at the same time, right, you not only have the data coming in weak, you had the stock market sell off and go back up, bonds also started to rip and start to go up higher. Yes, there was Bank of Japan that came out, wasn't as hawkish as people were expecting, gave a bid in stocks and bonds. But then after today, you have a typical risk-off sentiment where bonds were moving up today and stocks basically all day selling. And there could be many reasons why. One, we've been rallying for already 7 days straight. Two, we're at the technical levels. If you look at the chart, at the resistance, the long-term resistance, if you look at your daily, weekly, monthly charts, we're right there. So we've got some selling happening right on that trend line. Third, we've got the Fed meeting coming up February 1st. We need to hear what they've got to say, what the Fed has to say, right? And, some people argue that it could also be some of the Fed members that came out today. Some may argue that the comments they said were hawkish. I would say more in line or as expected. Maybe little bit, some comments here tilted to hawkish side, some to the dovish side, but overall really in line. And on top of that, you also had in the equity markets, just you could argue profit taking since the last 7 days has been a rally, right? So these are the major things that were really moving the markets, that were shifting the markets, and you do see selling today in the stock market. Bonds up does signal to you it's a risk-off kind of sentiment. The other thing that people could be thinking is that, hey, although this data is bad, maybe we shouldn't be buying into this and be selling equities. But I wouldn't take that analysis to heart, thinking that bad news is finally bad news for stocks. I would still say that the markets are moving on the concept and the ideology that bad news is good for stocks until maybe they realize that Fed might be doing more and that bad news is actually really bad news and it's not what we expected, and then boom, some selling happening. But I wouldn't say today's selling is because of the PPI number and the retail sales number. Now, on top of that, we had Bullard that came out basically suggesting, and again, you could argue this, that he would prefer a 50 basis point rate hike in February. So you could say that selling could be coming from him. But again, you could also argue, since he's not a voter, who cares what Bullard thinks, right? He did say that he would want to see continuation of rate hikes to go up higher. And he was the one who also talked about the Taylor rule, getting rates above the inflation level. Long ago he mentioned that, but not in today's talk. But mostly today's talk, the highlight was the 50 basis point rate hike, and continuing with the rate hikes as usual. Now, the thing is, with the 50 basis point rate hike, if you do that in February, right now the markets are pricing in February 25 basis point rate hike, then another 25 basis point rate hike in March, and then a 30% probability of another 25 in May, right? So if you do a February rate hike of 50 basis point, then does that mean that's a one and done? Does that mean, okay, boom, we do a rate hike and then boom, we're done? And if we do get that in February and we do get a one and done kind of scenario and the Fed tells us that, then sure, you could get an initial sell-off and then boom, a rally back up in the equity markets because they paused, right? So the equity markets are really waiting for some pause, some sort of pivot, confirmation of this. Now, Mester did come out and say that we want to continue to raise rates. We don't see evidence of inflation coming down. We want hardcore evidence that inflation is coming down. And then we will want to then eventually pause for some time. So she did mention about a pause that is likely to come. So these are some nuggets and some hints that, hey, looks like a pause is likely to come, and that how the markets are pricing in and are expecting a pause like they have been since this past couple of weeks and months. Looks like it is now slowly coming true. But again, that can all change on February 1st when the Fed meeting happens, and when the Fed and Jerome Powell comes out and mentions whatever, can mention anything he likes, right? But the biggest thing is that Mester did mention about this pause, and again, the comments that she said was pretty much in line, it was as expected, and not much you could say, and I wouldn't argue that today's sell-off is because of these comments. I would say more of profit taking, selling after a couple of days, jitters, worries, Fed meeting, earnings, etc., etc. Nothing much crazy unless I missed something. I don't know, right? So the biggest thing is that these Fed members are still going ahead with the rate hikes. What is very key for February 1st and onwards is that where are we headed in terms of interest rates? Do we go higher? Do we go lower? Do we pause? When does the pause happen? And Mester did say they need significant evidence. What is considered significant evidence? Right? We're down from 9.1%, the highs, down to all the way 6.5%. We all agree that, okay, inflation has peaked. We all are now agreeing that, okay, it looks like inflation is transitory, and that transitory story is now coming to fruition, which the Fed was talking about back in 2021 and was wrong. But now we're starting to see that play out, that the inflation is coming down. But inflation is coming down, how much significant evidence or numbers do you need in order to now consider a pause? Maybe we get that information in February. Maybe not. I don't know. It could be very tricky. Let's see what happens on February 1st. But if you are getting some sort of significant evidence, what could that look like? Maybe next month or the month after, we really start to get inflation from 6.5 to maybe 5% or 4%. But then let's not forget also another thing, that as inflation is coming down and it goes below 6%, that also means that we're in a recession and there's a big demand crunch, and the reason why inflation is coming down is because people are not buying, right? Because people are maybe got companies laying off, lowering their prices, there's not much demand. So that's a big component towards inflation coming down, and that's why the Fed wanted and was increasing interest rates back last year, and still going on with increasing rates even this year, right? So a big component of inflation coming down is because we're getting the demand crunch. We are in a recession, right? Now, if we are in a recession, we have the demand crunch. The question is, yeah, recession is priced in. We all know recession is coming in, but how bad is the recession? Soft landing or hard landing, right? That's not really priced in. If we really get that hard landing, then sure, you could see more days like today, where you get the stock market selling off, bonds going up, right? So today was, a good example, a good preview. If you go look at your charts today, go look at the stock market, go look at the bond market. Bond market's been rallying today, stock market's been selling off. Perfect risk off sentiment. Last year we had stocks and bonds selling off because you got the hike of the interest rates and the quantitative tightening and what have you. Could it be that this year you've got the break of the correlation where stocks sell off and bonds go up? Sure, definitely. Many things are possible. Let's wait and see what happens. I think it's going to be very important to watch out and hear what the Fed has to say on February 1st, and hopefully they do give us something. Anyways, leave a comment below. Let me know what you guys think. Hit the like button, bell icon to be notified on the next video, and subscribe if you like content like this. And I'll see you guys around. Cheers. Bye.